Kevin O'Leary has just announced that he's exited all of his crypto holdings. The Shark Tank investor made one of the boldest moves of his career, liquidating every altcoin, meme token, and speculative play in his portfolio to concentrate entirely on just 2 assets. According to O'Leary, this decision isn't simply about streamlining his investments. It's a deliberate shift to prepare for what he believes could be the most powerful phase of the current crypto cycle. A stage driven by structural market forces that most investors haven't even recognized yet. In this video, we'll unpack why Mr. Wonderful decided to abandon dozens of smaller crypto bets and consolidate into 2 major positions. We'll examine the institutional accumulation that's creating serious supply constraints in both Bitcoin and Ethereum. O'Leary has been increasingly outspoken about his research team's latest findings, and their data on market positioning paints a fascinating picture of what's unfolding right now. Before we begin, a quick reminder, only a small percentage of viewers are actually subscribed. If you're finding value in these breakdowns, take a moment to hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's get into it. Here's Kevin breaking down why he cut his crypto holdings from 27 positions to just 3.
If I want exposure to crypto, I only need 3 positions now. I used to have 27.
This isn't routine portfolio rebalancing, it's a complete change in how one of the world's most recognized investors approaches digital assets. O'Leary's research team spent months studying thousands of tokens, new DeFi projects, and emerging blockchain trends. Their takeaway was simple but bold: none of it was necessary. According to Kevin, there are only 3 positions worth holding: Bitcoin, Ethereum, and a stablecoin. In his view, that combination captures the foundation of the entire crypto economy. Bitcoin as the hard asset, Ethereum as the infrastructure layer, and a stablecoin as the liquidity bridge that connects both worlds.
But if you look at statistically, the volatility of just Bitcoin and Ethereum and a stable coin for liquidity, we pick your stable coin. Some people like Tether, some people like USDC. That's all I need to own.
What makes this strategy remarkable is its simplicity. It cuts through all the noise that usually surrounds crypto discussions. There's no speculation over which layer 1 network might dominate, no hype around meme coins, and no complicated yield farming schemes. Instead, it focuses entirely on 3 assets that represent the core of the crypto ecosystem: Bitcoin, Ethereum, and stablecoins, each reflecting a piece of the industry's lasting value rather than its passing trends.
I want a 2.5% weighting in Bitcoin in any portfolio, and I do a 2.5% weighting in Ethereum, and both have performed very well for me.
The precision behind these allocations reveals everything about O'Leary's mindset. This isn't about speculation or chasing the next explosive rally. It's a carefully structured portfolio built around defined risk limits and clear objectives. What makes it even more intriguing, though, is the yield component that underpins the entire strategy.
The strategic reason I do that, because I can wrap Bitcoin and Ethereum and get yield on my portfolio every month. So that's what I do. I'm not telling people what to do, but when I own assets, I want yield, I want distributions, I want something while I'm waiting for price appreciation.
This approach redefines how crypto fits into a portfolio. Instead of treating digital assets as speculative bets, it turns them into income-producing holdings similar to dividend-paying stocks or bonds. By tokenizing Bitcoin through Ethereum-based protocols, O'Leary earns consistent monthly yields while still benefiting from the potential price appreciation of both assets. The reasoning behind O'Leary's focus makes sense once you understand what Bitcoin and Ethereum truly represent in the larger crypto landscape.
When crypto sort of started, there was a whole bunch of meme coins and tokens and securities, 10,000 of them that are out there. But you don't need to own any of those to get exposure to whatever you think the value of crypto is.
What he's emphasizing is the core mistake most new investors make, chasing complexity that adds no real advantage. Thousands of altcoins claim to offer groundbreaking technology or life-changing gains, but history shows a clear pattern. The vast majority of significant price performance and institutional capital continues to concentrate in just 2 assets, Bitcoin and Ethereum.
And I'm talking about the price volatility of Bitcoin and the alpha that would give to your portfolio if you believed in Bitcoin. So I've taken a whole new strategy since we last talked about this. I'm focusing on 2 securities, Bitcoin and Ethereum.
The term alpha, as O'Leary uses it, is key to understanding his reasoning. In investing, alpha refers to the excess return generated beyond what overall market movements can explain. According to his research team, Bitcoin and Ethereum already deliver enough alpha to make holding any other crypto assets unnecessary. In their view, these two alone provide the performance, liquidity, and long-term upside that the rest of the market struggles to match.
If you think about owning crypto, what you're exposed to is price volatility. Sometimes it's good, sometimes it's bad. Sometimes it goes up, sometimes it goes down. But with the advance of a stablecoin act, for the first time we're thinking about, okay, financial services and Wall Street, to put it lightly, they're going to go on chain now.
Kevin's reference here points to the Stablecoin Act, specifically the Genius Act, which was passed in July 2025. This legislation marks a major turning point in how traditional finance interacts with blockchain technology. It established clear regulations that allow major financial institutions to operate on public blockchains such as Ethereum without the legal gray areas that once held them back. That clarity has been a key catalyst behind Ethereum's recent surge in value. The Genius Act effectively gave Wall Street permission to start building on Ethereum's rails, opening the door for large-scale integration, tokenized assets, and institutional-grade applications that are now fueling its growth.
You know that because if you want to transact with a stablecoin as a payment system, you need to put it on the blockchain. And which blockchain is getting the majority of that? Ethereum.
The data supports this shift clearly. Ethereum now holds around $165 billion in stablecoins, accounting for roughly 57% of the entire global stablecoin market. Even more striking is the recent growth rate. The network has been adding close to $1 billion in stablecoins every day, marking the fastest expansion recorded so far this year.
And so the only two securities that you see highlighted around the world each day, minute by minute, as they get priced, are Bitcoin and Ethereum. And so if you own those two, you're exposed to over 90% of the alpha and volatility of the entire crypto market. So why own anything else? I don't anymore.
The 90% figure isn't an exaggeration. It's based on real market capitalization data and price correlation studies showing that Bitcoin and Ethereum account for nearly all meaningful movement in the crypto market. Kevin's argument is straightforward. If two assets capture about 90% of the upside, owning dozens of smaller positions doesn't add value. Bitcoin and Ethereum already represent the heart of the entire space. Interestingly, O'Leary wasn't always optimistic about Ethereum or crypto in general. Only a few years ago, he was one of its most vocal critics. So what caused the shift? Let's look at the bullish developments that changed his outlook and convinced him to make Ethereum one of the only two crypto assets he continues to hold. The biggest factor behind Kevin O'Leary's new bullish stance on Ethereum is a major shift happening in institutional markets, the rise of Ethereum treasury companies that are rapidly accumulating huge amounts of Ethereum. This development is unlike anything seen before in the crypto space. At the front of this movement is Bitmine Immersion Technologies, the largest corporate holder of Ethereum. Bitmine owns around 3.4 million Ethereum, valued at roughly $13.25 billion. Bitmine isn't the only player. Sharplink Gaming, the second largest Ethereum treasury company, holds about 859,000 Ethereum valued at $3 billion. This rapid institutional accumulation is producing what analysts describe as a supply squeeze. Wintermute, one of the world's largest market makers, recently reported that its over-the-counter Ethereum inventory has been nearly depleted. That scarcity makes Ethereum far more sensitive to new capital inflows. It takes about $135 million to move Bitcoin's price by 1%. For Ethereum, the same effect can occur with less than $70 million. When large institutions buy at this pace, even modest additional inflows can drive sharp price movements. And if you want to stay ahead of these institutional moves and understand exactly when market conditions are shifting, I break down the latest developments every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. You'll get insights on everything from treasury company buying patterns to when the market is getting overheated, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Now, while corporate treasuries continue to absorb Ethereum's supply at record speed, another factor driving O'Leary's confidence in Ethereum is the rise of stablecoins.
So you're really trying to capture three momentums. One is Bitcoin is here to stay, and it certainly seems to be a store of value, number one. Number two, Ethereum is probably the platform right now that is getting Wall Street on chain and certainly providing for transactions with stablecoins, which are now legal all through the United States. And together, they provide yield.
This statement captures the essence of the investment thesis. Bitcoin functions as the digital store of value, Ethereum operates as the foundation for financial infrastructure, and together they form a system capable of producing yield while continuing to rise in value.
So you don't have to be an expert on, understanding 10,000 tokens and how they work together, or any of that anymore. In my view, and what I'm doing is just simply owning two of those, making them work together, getting a distribution every month. I'm pretty happy with that outcome.
This simplicity is what makes O'Leary's strategy so powerful. Rather than chasing the next breakout among thousands of speculative tokens, he focuses on the two assets that embody roughly 90% of crypto's real value. By concentrating on Bitcoin and Ethereum, both yield-generating and foundational, his approach combines meaningful upside potential with built-in downside protection. Based on O'Leary's insights and the institutional patterns shaping today's market, there are several key takeaways for positioning in the months ahead. Start with the allocation model O'Leary uses. 50% Bitcoin, 50% Ethereum, plus stablecoins for flexibility. This structure provides significant crypto exposure while limiting the risk of major portfolio drawdowns. The important part is to view these holdings as long-term strategic positions, not short-term trades. Next, consider the yield opportunities built into this strategy. By tokenizing Bitcoin through Ethereum-based protocols, investors can generate consistent distributions while still capturing potential price gains. This turns crypto from a speculative bet into an asset class that can produce steady income over time. Then, pay attention to the supply trends. Institutional treasury companies continue to absorb large amounts of Ethereum, while staking has locked up around 30% of total supply. That tightening flow, combined with sustained demand, creates an environment that supports gradual and durable price appreciation. Also note the expanding role of stablecoins. With $165 billion already circulating on Ethereum and new federal clarity established under the Genius Act, growth in this sector is likely to persist for years. This strengthens Ethereum's foundation as a core piece of financial infrastructure, not just a speculative asset. In essence, O'Leary's simplified framework, centering on Bitcoin, Ethereum, and yield generation, may represent the most rational approach for the current stage of the market. Instead of gambling on unproven altcoins, focusing on the assets that drive 90% of crypto's real value while earning consistent returns offers both growth and protection. The market is transitioning from speculation to structured adoption, and those who understand this early will be in the best position to benefit. The priority now is quality over quantity, building exposure to assets with lasting institutional demand rather than chasing temporary hype. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.